distinguished ladies and gentlemen, it is truly an honor and a privilege to be here today to share my thoughts with such an esteemed and exceptional group of leaders in Ghana. In fact, I feel like I should probably be the one sitting down taking notes and drinking from the fountain of your collective wisdom. I am thankful and grateful to Legacy and Legacy for the kind invitation and the honor bestowed upon me. Without further ado, I shall share some thoughts on financial optimization and repositioning for growth. These are truly challenging and turbulent times in our beloved republic. Having been the fastest growing economy, not only in Africa, but the whole world in 2011, we are now headed for the third successive year of slower growth as the double-edged sword of twin deficits, our current account deficit and our fiscal deficit, pierces our economic buoyancy and threatens the gains of the last decade. We experienced strong and broad-based economic growth over the past 2 decades, outperforming our regional peers in economic development and poverty reduction, propelled by outstanding democratic credentials and a highly rated business climate relative to our peers. Businesses today already face problems including lack of access to affordable credit and unreliable electricity supply. High interest rates and a weak and continually declining currency have only exacerbated our economic malaise. But the real crisis lies in a crisis of confidence that both investors and the business community have in our economy and the managers of our economy. As a venture capital investor and an entrepreneur with a well-diversified portfolio, I have felt the pain and have been forced to make painful decisions to downsize some of our portfolio businesses in Ghana. But I've also seen the diamond in the dirt. I have witnessed our healthcare businesses experience robust growth, even in US dollar terms. Double-digit growth in the face of 40% plus depreciation in the currency. After all, when you are sick, you're not going to say because the dollar is 4 or 5, you're not going to seek medical care. And I've seen and strongly believe that we'll continue to see significant distress, which will produce extraordinary investment opportunities. Where does this leave business? And how can we best position ourselves? I remember the story from when I was a little boy. I had scored 96% on an exam. And my mother, who's here today, was furious. Where is the 4%? She fumed. My brother Bangu attempted to defend me. And she was unrelenting. She said it was multiple choice. The answer was right in front of him. As I reflect on that exam, one way of being familiar with those answers was if I had gone over all past exams. Because history tends to repeat itself. Similarly, in looking at our economic and financial crisis, we need to look at history for lessons. So I went to history, and I looked at 3 distinct crises in world history. The Weimar Republic, 1921 to 1924. Zimbabwe, 2003 to 2009. And the recent global financial crisis, 2008 to 2009. How did businesses fare and position themselves during those periods? And what lessons and insights can we learn? Interestingly enough, throughout all these crises, including even the Great Depression, consumer spending did not change as significantly or deteriorate as rapidly as the macroeconomy did. But companies struggled to change their cost structure quickly enough to adapt to the rapidly changing economic circumstances. I called my old classmate Jamie in New York, who works for a large multi-billion-dollar macro fund. And I discussed this speech with him. He said, Sangu, isn't your focus on Weimar and Zimbabwe a bit drastic? I mean, Ghana is still growing at 5 to 6%. I said, Jamie, I will never forget my experience on Wall Street in 2008. I was at Goldman Sachs at the time in their special situations group, where we invested $40 billion on a principal basis using the firm's balance sheet. The top investment banks, Goldman Sachs, Morgan Stanley, Lehman Brothers, Merrill Lynch, and Bear Stearns, were the cream of the crop on Wall Street. And Goldman prided itself on being the film off the top of that cream. That summer, we were on a high. Earnings couldn't be higher. And everyone started dreaming, and in their dreams spending another record year of bonuses. This was only August. By October, Lehman Brothers, the storied 158-year-old investment bank that had survived the Great Depression, collapsed and was no more. Bear Stearns, where I worked in 2007, ceased to exist. Merrill Lynch was forced in a sale to Bank of America. The economic devastation was unprecedented since the Great Depression, and trillions of dollars were wiped out in consumer wealth. But only a few months earlier, we were smiling and laughing and dreaming of how we'll spend our bonuses. This is why, in our current crisis in Ghana, I think it's prudent to imagine and plan for economic Armageddon scenarios. What if the dollar reaches 10 Ghana? Do you have a plan for it? There are two ideas I will humbly offer for consideration. The first is recapitalization. In the famous biblical tale of David and Goliath, David faces Goliath, this monstrous giant warrior from Philistine. David had no chance. Yet he was able to conquer him with a slingshot. In these turbulent times, a recapitalization can be your slingshot against our FX and economic Goliath. Going back to the global financial crisis, Goldman Sachs and Morgan Stanley ended up being the only first-tier banks that survived the crisis. How did they do it? And what lessons can we learn? Equity recapitalization played a huge role. Goldman Sachs sold $5 billion of preferred stock with a 10% dividend yield to the legendary American investor Warren Buffett, along with warrants to buy $5 billion of Goldman common stock at $115 a share. $10 below Goldman's share price when the deal was announced. Goldman, in addition, issued an additional $5 billion in common equity. Now, interestingly enough, the Goldman preferred that was held by Warren Buffett was structured such that it could be redeemed at any time at a 10% premium. So this gave Goldman the flexibility to pay off the issue if it could obtain more attractive financing later in a calmer market. To be fair, Goldman could have gotten a better deal by selling $5 billion of convertible preferred stock in the open market or to a group of private equity firms. However, Goldman realized that the key to the deal was not just the cash, but the imprimatur and the allure that comes from Mr. Buffett investing in your firm. It's the ultimate stamp of confidence. And in this crisis, which we have already diagnosed as a crisis of confidence, any steps to bolster investor confidence in your company is paramount and potentially transformational. Morgan Stanley similarly took in a life-saving equity investment of $9 billion from Mitsubishi UFJ in Japan. But Morgan also decided to change its business model substantially. It acquired Smith Barney's brokerage operations, repositioning itself more as an asset manager than a pure investment bank, thus being less exposed to the vagaries of the capital markets. Given our economic climate, it could be prudent to raise equity financing in US dollars to give you the financial cushion to ride out the storm and to also provide excess cash for the second suggestion I will discuss shortly. A lot of Ghanaian-owned businesses, to be frank, have a strong aversion to equity sales. preferring to own 100% of their businesses. I've had a lot of arguments with my old man about this. This year marks his 40th anniversary as an entrepreneur in Ghana since founding Rabito in 1974. And I appreciate his pride in and the need for indigenous-owned businesses. But as I argue with my dad, 100% of $1 is $1. 20% of $1,000 is $200. So perhaps our focus should be less on percentage ownership and more on value creation, especially where the dilution allows you to gain growth capital to significantly expand your valuation. Consider Mark Zuckerberg, who owns 22% of Facebook. But he's worth $33 billion. He's doing okay. Or Larry and Sergey, the co-founders of Google, they each only own 16%. But they are each worth $28 billion. They are doing okay. There are still ways to structure equity investments to preserve control. For example, in the case of Zuckerberg, he created a separate class of voting shares, of which he's the majority owner. So even with a 22% stake, he still controls the majority of the voting shares in Facebook. But not all capital is equal. As in the Warren Buffett example, and especially for publicly traded companies in Ghana, the choice of investor can be a powerful signal to the markets. The second issue for consideration is strategic investments. Going back to the legendary Warren Buffett, who said, "Be fearful when others are greedy, and greedy when others are fearful." With fresh financing from an equity issuance, you can have the dry powder to take advantage of the inevitable distress that will ensue. Zimbabwe's crisis here offers some compelling anecdotes. The legendary African entrepreneur, Strive Masiyiwa, founder of Econet, shares a story how during the Zimbabwean crisis, when hyperinflation took control of the country, and you walk in today, bread is 1 million, tomorrow is 1 billion. He decided to use his equity to make asset purchases. At one point, expanding the balance sheet by almost $1 billion. Because in that way, equity became a valuable currency for him to take advantage of the distress and to acquire assets at a significant discount to their intrinsic value. And it also gave him the staying power to be able to survive the crisis. And when it was over in 2009, he yielded the dividends of that long-term play. So what should guide your investments or acquisition strategy? Again, Buffett provides an example. Amidst the global financial crisis, Buffett acquired one of America's largest freight railway operators, Burlington Northern Santa Fe, in a deal worth $44 billion at a time when everyone was running away from America. He reasoned that just because we are in a crisis doesn't mean people are going to stop using trains. And even if demand falls, you are well positioned to ride a recovery. Buffett has always stated a preference for simple businesses that will not stop because of economic turbulence. And that's why he loves and is still one of the largest investors in Coca-Cola. Another consideration is Pan-African expansion. Look at West Africa alone. With the Francophone zone, you can have exposure to the CFA, which is pegged to the euro, or to the Naira, which has enjoyed relatively more stability. And you also have access to a larger market of 200 million people. For our investment portfolio at Golden Palm, I've been spending a lot of time in Francophone Africa, East Africa, and Nigeria, looking to diversify away from CD exposure. I believe we should go on the offensive rather than the defensive. Acquire today from a relative position of strength than be acquired tomorrow from your depth of weakness. In conclusion, we've explored two ideas: recapitalization and strategic investments, that are focused on financial optimization and repositioning of your business amidst this crisis. But there are limits to these strategies. Ultimately, what we really need is financial optimization and repositioning of our country. Our problems are structural, and band-aid measures will only provide temporary relief. We are badly in need of structural overhaul of our economy. We are in need of tax reform, where we can lower taxes, expand the tax net, and on a net basis grow receipts, as Egypt demonstrated in 2005, and I'll add, against the advice of the IMF and the World Bank. Egypt cut taxes to 10% and 20%, and tax receipts went up 50%. Egyptians reasoned, if it's 10%, why dodge? But we need to pull together and work together. We're in this together. And ultimately, Ghana's recovery will be a boon to all of us. And we will all enjoy the dividends of her economic success. Let me leave you on a non-financial note. Daniel Goleman, in his study of emotional intelligence, said that having hope means that one will not give in to overwhelming anxiety, a defeatist attitude, or depression in the face of difficult challenges or setbacks. Hope is more than the sunny view that everything will turn out all right. It is believing you have the will and the way to accomplish your goals. For the sake of our republic and the fortunes of our children, I wish you that hope, fortitude, and perseverance in these trying times. Our growth and our future as a nation depends on you. God bless you. God bless your businesses. And God bless our beloved republic.